Thank you everyone for joining us today for this Investor Network webinar with Aner Ben Ami of Candide Group and Neichin of Ceniarth, looking at FinanceFirst and ImpactFirst strategies through the lens of family offices. My name is Aner Ben Ami. I am the Executive Director of Transform Finance and the convener of the Transform Finance Investor Network. We'll turn to our presenters in a second. I just want to give you first a couple of quick updates from the Transform Finance Investor Network. The first and perhaps most exciting one, we're hiring an investor engagement manager at the moment based in New York. That will be somebody that largely will take care of these webinars and the rest of the content that we provide to our investor community. If you know anybody who might be interested in that, you will find more information at transformfinance.org/careers, and would encourage you to send them our way. That's something that we'll try to finalize over the next month or so. And secondly, perhaps a lot more excitingly, Morgan Simon, co-founder of Transform Finance and co-managing director actually with Aner at Candide Group, is coming out with her book, Real Impact. It will in Oakland. There will be a book launch party on October 5th. So if you happen to be there, we encourage you to join. Take a look at the book. You'll find information on it at realimpactthebook.com. Again, for those that just joined, if you don't mind muting yourselves, we'll minimize the background noise that way. So we went over, the position that we have open at Transform Finance for an investor engagement manager. Morgan's book, going through a lot of the topics that we have been covering with the investor network community. And lastly, we just issued a report. Many of you were part of it. I would like to thank you for the role that you played in that report on innovations in financing structures for impact enterprises that we just issued in collaboration with the Multilateral Investment Fund of the Inter-American Development Bank and the Rockefeller Foundation. If you want to take a look at that, you'll find it under our investor resources or under briefings. And our next Investor Network webinar will be on the 20th of September with Gary Community Investments, still exploring this issue of how to allocate the entire corpus of a foundation or a family office for impact, in this case with a place-based approach. So quickly to contextualize today's conversation before I turn it over to Aner. It's been years that folks have been looking at this issue of finance first, impact first, what is impact investing, where are we going? The basic answer is that it's not so simple. There are a few things that we need to look at to have a meaningful conversation around that will actually inform the practice of investors, which is ultimately what we want to do here. One thing that I want to highlight for today is this idea of looking at it from the standpoint of the investor's constraints. Based on the type of investor that you are, from family office to pension fund, you will be in a different position in terms of how you prioritize the impact aspect of your work or the financial returns that you're seeking. And looking at it from this perspective of investing across asset classes for impact, think about all the stuff where best you can do is improving what's there, right? Trying to minimize bad practices, trying to promote good practices, versus or what I call creating the new, or is investing for a new vision of the economy, a new vision of the role that finance can play for social change. In particular, if you come at it as we do from more of a social justice approach. So that's something that we'll break down today, and as you'll see, in part, what you can do in terms of improving what already exists versus creating the new is contingent on which asset class you're looking at. Within the public equities, probably best you can do is try to maximize the positive and avoid bad practices by public companies. In private debt, private equity, you're more likely to have that kind of additionality that we have historically associated with impact. And I'm not saying that I'm favoring one over the other, just because we need to be mindful about the amount of capital that flows into public markets and what we're going to do about that. We can't leave that to the side, versus the capital that goes into more direct, bespoke, early stage or private equity type of stage interventions. And lastly, the question of whether you're looking at it from a FinanceFirst perspective or an ImpactFirst perspective is different from the question of whether you can get good returns from good impact. And yes, you can. From a theoretical perspective, you certainly can, and there have been good examples of that being the case. But the questions remain of what do you do when there is a trade-off between the two, right? If your workers are going to be paid more, if your supply chain is going to be more expensive, which way are you going to go on those questions? And if returns are good, as say during the Global Steering Group meeting in Chicago in July, there was a big push towards the alpha that can be generated by impact investments. Well, then we should consider whether that's really where scarce impact dollars are most needed, or if we should think if we're in a position to drive more impact, maybe we should be looking at things that are not going to be crowded in by commercial investors anyway. And what are we going to do about all the interventions that have very high impact but might have lower return? Again, thinking about the fact that there is probably a whole spectrum out there, as Omidyar pointed out in its writings a while back. Are we going to just all be running after the ones that have the highest returns, or is there going to be the possibility of addressing all of the different opportunities that are there? Again, sorry, one last time, if you are not on mute, if you could please mute yourself, we'll minimize the background noise. And lastly, which is much more of a sort of transform finance hang-up, perhaps, if returns are good and we're pursuing this investment strategy for social change, how are we addressing the issue of the gap between the wealth gap between asset owners and impact beneficiaries, right? If we are solving specific problems in the way that, say, the SDGs seem to look at the issue of impact, but asset owners are still getting the type of returns that are simply unavailable for beneficiaries that don't have assets to invest in the first place, are we really making any strides in terms of solving the underlying issues that have created the problems that impact investing is trying to solve in the first place? And we'll leave it with a quote from Aner in terms of how we at Transform Finance have been looking at this. Are we really redefining who wins and who loses in the economy? And instead of butchering what that statement means, which might be different things for different people, I will turn it over to Aner, who is a member of our investor network, in fact, founding member of the investor network, and he's been a close collaborator. And we're very excited to have him here for this conversation with Greg. So thanks for joining us, Aner.
Thanks, Andrea. Yeah, and I'm first here to actually present and introduce Greg, who will be leading most of the discussion here, while I will sort of be interjecting questions, comments, and slides in between. But we'll mostly be hearing about Greg and the strategy he's leading over at Ceniarth. So Greg Nichiren, probably some of you might know, he runs Ceniarth, which is a single-family office representing a single asset owner, Diane Eisenberg, who's based in Wales, I think you'll see the single asset owner piece is probably quite sort of significant in this context. I think it's sort of part of that fierce independence that that Ceniarth is able to have, and their ability and sort of willingness to throw out whichever parts of the investment management playbook, or pick and choose which parts of the investment management playbook do or don't align with the goals and values of the asset owner. Andrea made reference to this a little bit, and it's something to keep in mind here as we have this conversation, as we look at the strategy, is which type of asset owner and which type of institution is family office foundation is well positioned to do this sort of work. So Greg, I think Greg and I both started doing this work around the same time. Correct me if I'm wrong, Greg. Probably about 5 years ago, and we both have a mandate around activating 100% of our portfolio towards impact, which means we both have been working across asset classes and trying to figure out how to implement and how to actualize impact across public markets, real assets, private debt, private equity, and sort of what it means in each part of the portfolio. Greg's work has been mostly focused on underserved communities in the global south, although I think you'll see and you'll hear from Greg, they've increasingly been looking at opportunities in the U.S. as well, in the spirit of the U.S. becoming more of a politically unstable autocracy. They've gravitated towards underserved communities in the U.S. as well. I think you'll hear plenty of specifics here about his work, but I do want to just kind of highlight a couple things that I think are interesting and kind of get me excited about Ceniarth and Greg's work. One, I think, as Andrea referenced, this notion of sort of self-questioning and perpetual improvement. I think if you're like me, you've probably heard many voices in the impact space who are conveying this sense of confidence that we've sort of figured this out, this impact thing, and how profits and purpose align, and there's the confluence and win-win, this win-win situation we're in. I think Greg is one of a small yet growing group of impact investors who are, continuously questioning what is truly achievable in terms of financial returns, and what is achievable from an impact perspective. And he's been a strong voice in reminding us that as impact investors, we're oftentimes here to invest or support solutions to market failures, right? And oftentimes, if the market has failed to address an issue, it's because for commercial investors, they've found it difficult to make money investing in that, in addressing that issue. So there's only so many instances where commercial investors are simply missing out on a great opportunity, and we can come in and kind of rake in all the profits and solve the social issue. Sometimes that's the case. Sometimes there's sort of an arbitrage opportunity, and maybe those commercial investors are mispricing risk, but certainly not always the case. There's often a very clear trade-off, right? The more money has to be paid off to investors like us, the less money is left in the company to do other things, including some of the impact work. So it may seem obvious to hear Greg talk about it, but it's sort of worth remembering that this is still a somewhat contrarian view in many ways. The other point I'll highlight is, I think, kind of beyond that age-old debate between concessionary and market rate returns, or the FinanceFirst or ImpactFirst debate, what I sort of really appreciate about Ceniarth and their approach is, I think they're sort of flipping that debate on its head. So rather than setting a financial benchmark and then saying, all right, well, let's see what fits in that box, or what fits in our box, I think they're asking the question, they're asking a different question, which is, which critical issues facing underserved communities can be addressed with a market-based solution. And essentially, if you're able to tackle some of those hardest issues facing underserved communities, and you're able to do so in a way that returns capital to investors, then ideally there should be some form of investment dollars available to do that. And then the final point really worth highlighting, and maybe it's redundant in the context of this conversation, is how transparent Ceniarth has been about their work. About their strategy, their doubts and concerns and successes and failures. So I don't need to belabor that point, because we're about to see a good illustration of that transparency here with Greg's presentation. So I'll hand it over to Greg, and I'll be interjecting in between some of my comments and questions. But
okay,
I'll hand it over to you, Greg.
Great, thanks, Aner. And it was a great summary of how we operate. We could probably move just straight to the Q&A. But I really appreciate everyone making time today to join the webinar. Thanks to Andrea for pulling this together. We're really excited about the chance and opportunity to present to forums like this, because we believe that the transparency that Aner just mentioned is absolutely critical to moving the sector forward, and that the more family offices and foundations and impact investors are sharing exactly what they're doing, the more we can all learn together. And I would say that sharing has to mean sharing more than just an anecdote or two. It has to mean more than sharing just success. It has to be really about getting honest about those failures and obstacles and the hard realities on the ground that all of us experience doing this work day in and day out. So here's the game plan for how we're going to spend the next hour. I'll give a bit of background on our office structure as context for who we are. I will dive into unpacking our mission and goals, and I'll do that in a pretty methodical way. I think we in the industry use a lot of jargon, and I think we can get lost in our own words sometimes. So there may be some repetition in what I say, but I think it's sometimes sometimes important to hit the nails 8 or 10 times so that it really makes sense. And then I'll get into our specific investment strategies and our decision-making process, and really some very specific examples of our portfolio. Aner is going to pepper in some color from his work at Candide, and I think it'll be a really nice sort of comparison and contrast in some points to how we operate, and hopefully we'll get done in plenty of time for questions. I know we circulated the slide deck in advance, so hopefully people have had some time to digest the material and can have some questions. So jumping right into to the office structure. So Ceniarth was founded in 2013. We're a relatively young organization. As Aner mentioned, we were founded by Diane Eisenberg. It's really the first comprehensive professionalization of the family office. And one thing I will say is that Diane is not just the asset owner in this case or the principal. Diane is really the day in, day out active leader of this organization, which I think has made a really big difference in our ability to operate quite nimbly and quickly and effectively in this space. So Diane's father, Gene, had built a string of industrial companies in the States, most notably a business called Neighbors Industries. It's one of the largest domestic oil field service firms in the country. He had done a variety of his own personal investing and philanthropic activity, including endowing the business school at the University of Massachusetts, which was the Eisenberg School. But he had not generally formalized those efforts into an office structure. So when Diane was given responsibility for managing the family assets about 4 years ago, she moved to do two things. Number one, to really formalize this structure and build a professional team. and two, to really build that office from the ground up with the explicit intent to serve the mission of putting capital towards its highest impact. Now, highest impact for Diane and for us as an organization, because impact means many things to many people. Impact for us has become improving livelihoods in underserved and marginalized communities. We do that through funding market-based solutions. We mostly do that in rural places, but not exclusively so. A little bit about just the structure of the organization. We manage both unrestricted and some restricted investment assets, as well as philanthropic assets in the form of a private foundation. We're unstaffed at any of those individual entity levels that you see in the picture. The entire staff sits at the family office level and then leverages the different entities as simply pools of capital. We manage roughly $500 million around across the entire family office. Around 115 million of it is in the private foundation, which is a publicly available statistic. And the goal of what we do that I'm going to really get into in detail is to deploy the vast majority of our capital in pursuit of that mission to serve underserved communities and to produce measurable social outcomes while substantially preserving our capital base and multiplying the impact of our philanthropic distributions. And that is quite a tongue twister and quite a lot of things to unpack. So, which is why I have the next slide. So I like to try to break down these individual phrases so that we are incredibly clear about what this goal statement means and what we're trying to accomplish. So the first part of that statement says, deploy the vast majority of our capital in pursuit of this mission. And what that means to us is that impact is at the core of everything that we do as a family office. It is the long-term strategy for all of our assets, and you'll see a bit about how we plan to sort of rotate assets over time toward categories that we view as having higher impact. It also means that the team has been built from day one with specialized expertise. So we have a team that comes from backgrounds in social finance and international development and agricultural economics to really serve this mission as opposed to being sort of a bolt-on to an existing office. And perhaps most importantly, it's the team in an office that has been built with a certain sense of cultural fit and a very clear program for incentive alignment around serving mission. I could do an entire session second webinar just on cultural fit and incentive alignment and how critical we feel that is to building an impact-driven organization. But needless to say, we think it's really important as you shape your institution. Part number 2 of the goal statement is produce measurable social outcomes. So as I mentioned, for us, social outcomes are the goal. We are first and foremost a funder of people and human livelihoods. We often have secondary impacts from the work we do. So for example, a lot of the work we fund in energy access obviously has secondary environmental impacts. But for us, the North Star for us is, are we day in, day out directly impacting livelihoods in deeply underserved places? Measurable, I think, is a very difficult part of that statement. We seek to measure the outcomes that we're producing through our investments on an intervention by intervention basis. The words on the page say this is admittedly not easy nor consistent, and I think that is very true. We do not have a kind of grand theory of everything when it comes to our impact measurement. We're not going to be the ones to stand there and say we've touched 10 bazillion lives in aggregate. Our focus is really working with each enterprise that we fund to define specific metrics in a given context for what defines impact, and to track those over time, and to be rigorous about that tracking in terms of it helping to drive follow-on investment decisions. Next part of that statement says, while substantially preserving our capital base. So I think that when we think about returns, or we think about what does this capital base look like in the future, we try to do that in as much of a vacuum for ourselves as possible. We don't spend a lot of time thinking about what the market is doing. We don't benchmark what we're doing against market rate, because I don't even know what that means in general. We really have tried to shape this vision based on what is right for Diane, what is right for the family office, and what is right actually for achieving the kinds of impacts that we're trying to achieve in the areas we work. And for us, that's really meant today a bar that says, how can we work to preserve the value of these assets really on an inflation-adjusted basis over time, while driving as much impact as possible. I'll get into what that really means. It essentially sets a pretty low, low hurdle rate in terms of what we try to achieve with returns, but allows us a lot of leeway to pursue some really hard opportunities in some really marginalized places. And I think that this is a really kind of liberating vision that Diane has laid out for us to sort of work on, and gives us a great deal of flexibility. I'll also add that the goal of preserving the asset base is not one driven by financial need or liquidity needs or spending needs. It's really driven by our belief that we want to be investing in sustainable enterprises that recycle capital over time. And that's generally why we've set that bar, because we feel it's a good good proxy for whether we're choosing the right organizations. And then lastly, as a piece of that goal statement, says multiplying the impact of our philanthropic distributions. This really speaks to the point that the majority of the money that we put out of our foundation in the form of distribution requirements are in the form of PRIs. And that we hope to recycle that capital over time. We do a limited amount of pure grant making, but really reserved for incredibly high impact opportunities, or where we feel it could catalyze additional capital in a particular situation. Moving on, how do we translate that goal statement into our investment strategies? So at the moment, we operate in a world with really three parallel initiatives in the office. And later in my slides, I'll show you how these initiatives map to the entities that I laid out, because I think it's important to make sure that those dots are connected. We operate in a world where we do think that there are trade-offs. We don't really view this as a debate. We don't really have much use in debating people about this sense of market rate returns versus impact. We just we do the work, and we observe that in the hard places that we work on issues of poverty and in marginalized communities, that there are trade-offs, and that increasing risk and reducing return expectations can allow one to have greater impacts on poverty. How that philosophy is mapped is essentially that we manage one pool of capital in a finance-first manner. I'll get into what responsible asset management means for us. We manage two other pools in what we call impact-driven capital preservation, which is really ImpactFirst, and a programmatic pool, which essentially is our PRIs. Our long-term goal as an office is to move as much capital as we can to the right-hand side of this chart, to really get out of the business of basic responsible investing
and really be solely in the business of kind of impact-driven investing.
If I may for a second, Greg, just for those who are not seeing the slides, if you can go back for a second, we'll just read it out to them.
Sure.
So we have two axes. We have risk appetite on one side and strategic intent on the other, and we have a low risk appetite, FinanceFirst, the responsible asset management that Greg will get into. ImpactFirst, low risk, is the impact-driven capital preservation, and high risk, ImpactFirst, is the PRIP, so programmatic investing.
Yeah, and I would say that the risk axis is, to us, more important than the return axis, in the sense that for us, we place the most scrutiny on capital impairment rather than expected return. So, when we're in deep diligence on an investment, that's we're spending less time on, do we feel like this is really going to be an 8 or a 4 or a 10, and a lot more time on what is the probability of real capital loss on a particular investment. I can get into what that looks like in reality, but I think that's why you see risk mapped versus this is, as we tried to simplify this matrix, why you see risk mapped versus return or something else mapped there. And then before I let Aner give some comments on how this might compare or contrast to how he thinks about this at Candide, just to break apart those three strategies, the first strategy, responsible asset management, is really a global mandate across a conventional portfolio, includes allocation to both public and private investments. It is a portfolio that essentially is geared toward generating returns consistent with a conventionally managed portfolio. I would have written market rate if it wasn't a term that sort of nauseated me. But the impact alignment of our responsible portfolio is quite broad leeway to sort of allocate to managers that are working on social or environmental theses. These could be in developed or developing markets, or traditional strategies with best-in-class ESG consideration. I'll go through examples of these managers. I would say that for the most part, my view is that the managers you'll see on the slides toward the end of the deck are really the managers that have come to be known as what the field of impact investing is. I think for us it feels a little sad in some ways that this sort of responsible investing has become the bar at which the field declares mission accomplished. We feel as if there's a lot more room for achieving impact if one moves beyond that. Now, I think we certainly concede that for various fiduciary reasons or financial need situations, that actually responsible investing is a laudable goal and should be celebrated. But for other asset pools that have the ability to take greater risks, we really would like to try to move the field beyond this sort of sense of simple and basic responsible investing. The second strategy outlined, which we're continuing to move more and more capital into, is this idea of impact-driven capital preservation. This is a portfolio where everything that is going into this portfolio has a direct and measurable benefit for the kinds of communities that we want to serve. It is a portfolio that ends up being heavily weighted toward private credit and real assets with some private equity. And again, it's the financial goal of this portfolio is to preserve capital at essentially an inflation plus some expense adjusted basis. And then finally, the third strategy that we execute on is called programmatic. It generally lines up with the work we do on PRIs, though not exclusively so. There's some unrestricted investing that falls in this programmatic category. And again, these are investments with clear and direct and measurable benefits for our target communities. The thing that differentiates programmatic from capital preservation is that these are investments where there is a high risk of capital impairment or very negligible returns. And after Aner speaks to what he's doing at Candide, I'll get into a bit of a decision tree of how we fit different investments into different categories. But hopefully that's a basic sense of how our strategies lay out. Aner, maybe I'll turn it to you to kind of compare and contrast how you think about all this.
Sure, and I'll just take a second to, in the spirit of Greg, what you said about hitting the nail on the head 8 or 10 times, not to repeat too much of what you said, but just to reemphasize the point around the capital preservation piece and some of the comments Greg made around not measuring to a benchmark and not being too concerned with which benchmark they're beating. I mean, to somewhat state the obvious, I mean that's a pretty big deal and a pretty major departure from how the conversations are usually take place. And I think anyone doing this work, I think will probably identify with the fact that whenever you describe your work as an impact investor, pretty much the first question you get asked by anybody is, oh, and is it generating the same returns, or is it generating stronger? It's pretty much the first question within the industry, outside the industry, right? So pretty much just putting that question aside is is a pretty major deal. But it also kind of speaks to I think the point I was alluding to earlier, which is kind of flipping the whole sort of debate on its head. So it's not so. I mean, the big rationale or sort of the impetus around generating competitive returns is understandably, if we prove out these competitive market rate returns, we're going to attract a lot more capital to the space, and that's true enough. Certainly true for the what Greg calls the responsible investing part of the space. But I think kind of the way they're posing the question upside down is concerning themselves less with what other investors are doing and more with what the market or the beneficiary communities, underserved communities need, right? And sort of letting that lead the conversation around which investment strategies should be investable. So I'll do just a quick detour here. I mean, I think when we talked about Greg and Ceniarth's approach, I mean, there's certainly some similarities to our work at Candide and some nuances as well. So maybe worth highlighting those. And to be clear, with Candide, we have been sort of implementing a similar sort of 100% strategy for a single asset owner, single family under the name PI Investments for 5 years, and many of the examples here come from that portfolio, and then have more recently have been doing very similar work with the Libra Foundation. And I think this approach sort of describing here is fairly much applies to both those asset pools. So I think in general, how we think about asset allocation and different return targets for asset classes, I think we actually start from probably a more conventional asset allocation exercise that doesn't differ much from any sort of non-impact asset allocation exercise, and we end up with a pretty dull or boring or asset allocation in that the percent of the portfolio that is currently allocated towards public equities, fixed income, private equity, real assets is not too unconventional, and it kind of reflects the risk return and liquidity needs and asset class correlations and assumptions that you typically see with any asset allocation exercise. And then where we do sort of differ a little bit from orthodoxy is within each asset class. So let's say there's a 15% allocation towards private equity in the portfolio. Within that asset class, within private equity, we do we are intentional about making room, making space for higher impact strategies that may require either taking on greater risk or taking a sort of a lower return. By the way, I kind of always sort of emphasize the or a little bit. Sort of hopefully it's the greater risk or lower return. And one point to keep in mind, I think, when you're doing this sort of work, and if you're Greg and you come to be known as this investor that is willing to really step out when it comes to high impact opportunities, you also have to be a little careful that you're not just being identified as the dumb impact investor that's going to take on just a crappy deal with really high risk and really low returns. Just a part of what you have to navigate. And I think so. Essentially, what that means is we're using the return target for an asset class as a constraint, if you will, right? So if private equity target is, let's say, 8% or 9%, and we think there is a portion of that portfolio that is going to hopefully outperform that and is being underwritten to a higher return, that gives us the flexibility to be able to take on more risk or lower returns for parts of that allocation. That's essentially we split each asset class into those three subcategories. Let me just go to here are the three. So the three subcategories we have within each of those private asset classes, within private equity, within private debt, within real assets, we'll have a bucket for so-called market rate, kind of more good risk return profile, and where the bar for impact is, it's going to be good. If it's great, even better, but it's got to at least meet some basic standard, basic bar. There's an example here, which would be like a DBL Partners would be an example of a venture fund, pretty well established now, shooting for very much commercial returns. That would fit into that first category. Our relatively low execution risk and high return, and an okay or good impact profile, and then we make sure to leave room for these two other subcategories. One where there's higher execution risk, and that might be a first-time fund manager or really sort of unproven strategy or unproven manager. The example here is a fund called Impact America that some of you might know that is sort of focused more on a venture fund focused on investing in underserved communities in the U.S. Or the third category where we think there's a low probability of capital impairment, but also probably a lower return hurdle, lower return bar. So in these three categories, I would say map fairly close to the three categories Greg just described, right? So the first category should be kind of the good risk return profile, and okay impact would be what Greg has called responsible asset management. A higher risk, higher impact would roughly correlate to your programmatic investing, and the lower return, high impact category would roughly correlate to your impact-driven capital preservation bucket. And I think again we just feel like that it's just important to make intentional space for those concessions, for those categories, because in recognition of one, the fact that this is an emerging field with emerging managers and emerging strategies, right? And if we're waiting for all of them to have that solid sort of risk return profile and proven track record, we're going to be there's not going to be a bridge for that next for that next set of managers or strategies a la Impact America to make their way up that ladder. And two, because we believe that there are, similar to what, to Greg's point, that there are strategies that are never going to be, have a terrific return. They're just structurally, inherently require a lower cost of capital to achieve. So that's sort of the rationale for those subcategories.
So just to summarize that quickly, one uniqueness in the approach that you're taking at Candide, if we're getting it right, is that you have a certain return expectation within the asset class, but within that you're able to modulate up or down depending on where the opportunities are, trying to shoot for one.
To make it sort of simple, example with simple numbers. Let's say your return target is 8%, and you've managed to make an investment with a 10% return. Theoretically, that now allows you to go out and pursue an investment with a 6% return and even out at 8, right? And we'll obviously pursue those low return opportunities as a function of where we think the impact is more transformative or catalytic.
And I would say, actually, there's an element of that blending that's not dissimilar to how we think of even our capital preservation strategy, where just because we've articulated a low hurdle rate for the portfolio doesn't mean that we turn away returns when when we're in a context where the right investment is a higher yielding investment. We're not, there are opportunities we see where the right cost of capital in that situation is higher, and the way we view that is, we'll take that return, and that helps us blend out in that capital preservation portfolio. In the cases where we might take, take a 1% or a 2% return in that portfolio. So, it makes good sense to me how you're thinking about that. So I think, I think one thing that's interesting, sort of taking it from sort of those categories to how does this work on a daily basis when our teams are trying to think about what bucket these things go into. We've got this decision tree that we've laid out. Now, this is not, I'll say it's not as simple as this, but I think it gives a good sense of how we think about differentiating opportunities. And I think it's important because we don't start with a team that basically is segmented into sourcing ideas for a particular strategy. We generally source ideas and then fit them into a category when we like them. So, the decision tree basically says, impact drives everything. So if there's no or very low impact to a strategy, then I think those are just ones we pass on. When it fits that bar of medium, which to steal Aner's words is sort of the okay or good category, we tend to pass that off into the responsible investment mandate, and then we're really looking for kind of institutional quality and really great managers. So we're not sort of lowering the bar for quality of team, but allowing a broader interpretation of what impact means. And then if impact is on target for our view of direct and measurable for underserved communities, then we begin assessing risk. And if we're in a high impact and high risk scenario, generally that's going to end up in our programmatic pool in the form of PRI. If we're looking at a low risk or medium risk investment, then it tends to come down to an issue of returns, where if there's low risk and even a decent return, and decent I'll define as above 1 or 1.5, it's generally going to find its way into our capital preservation bucket. If it's a really negligible return, or say a zero interest loan is what's needed, but even if zero interest loan is coming with relatively low risk of capital impairment, it probably will end up as a PRI. And then I think in some of those medium risk categories, again, that bar tends to move. This is not a science by any means. This is really kind of an art on a deal by deal basis to kind of figure out which pool of capital an individual opportunity finds its way into.
Curious if you found if these break points, 5%, 1.5%, is that just been more informed by what you've seen in the market, so more things that look like this?
Yes, I would say that this is mostly just a result of sticking things. Basically, if we compare our pipeline to those break points, I think we've just seen enough now over 3 or 4 years to say, like, hey, this looks and feels like something we did as a PRI for this reason, or this looks and feels like something we can get comfortable with on the capital preservation side. I think, as I mentioned earlier, that it's useful to map, before we get into specific examples, to map how these strategies layer on to the entities that I mentioned earlier. As I mentioned, family offices can be complex in that we're managing multiple pools of capital with, different specific mandates. So, this is just to say that today, and these things are all subject to change because we, as Aner mentioned, we're sort of in constant evolution, but that responsible asset management strategy is really used with our foundation endowment. It is primarily diligenced by an outside firm that we work with an internal investment committee and internal discretion over everything that's approved. The capital preservation strategy is generally leverages unrestricted investment dollars, and it's a strategy that's managed half through a second outside advisor, again with an internal investment committee, and half through our internal investment team, primarily in the form of direct lending activities, so we'll get into specifics, again with an internal investment committee. And then the programmatic work is all done internally in the form of the foundation PRIs and grants, again with an internal team and internal investment committee.
So, Greg, I'm just curious if is there a reason why in your case the family office is where you sort of led with the capital preservation part of the strategy, and then the foundation is where you lean more into the responsible asset management part of the strategy?
Yeah, it's a good leading question. The answer is that there is, and it's because we view our unrestricted investment assets as somewhat our most risk-taking assets. I think it's somewhat flipped in terms of how many individuals and families think about their sort of emotions and psychologically think about their asset bases. So a lot of people will put their most philanthropic and risk-taking capital in the foundation. In some ways, we view the foundation as the repository of our best ideas that will kind of live in perpetuity and form the basis for something that can do great and sustainable work in the future. And we view personal investment capital as as our experimental risk-taking capital that can really push and pioneer things that eventually we can move into the foundation to kind of be solidified for the long term. So I think that's that's why we've done that, because of sort of Diane's very kind of unique approach to thinking about the asset base, and so that's why why you see that, why you see the foundation being in some ways the more conservative element, or the foundation endowment being the most conservative element of the portfolio. Okay. So moving on to kind of getting into some examples, and I think I'll race through these because I do want to make sure we have plenty of time for questions, and everyone has these in front of them, so I'm certainly not going to going to read out all of these investments, and you can find them on our website. And this is, we try to be very open about everything that we're doing. This is essentially the vast majority of the responsible asset management portfolio today. There's a few things that probably got missed, but you'll see some very usual suspect names in here across both public and private investing. We certainly could debate which category they, would fall into, and what I would say is reasonable people can disagree in terms of placement of these. This is sort of just where things fall out, for us. You'll see a number of firms that are focused more on developed markets, firms like Bridges Property in the UK, or Bain's Double Impact Fund in the US. And you'll see some in developing economies, most notably Helios, but Helios is a very large private equity firm focused on, really major industrial sectors in sub-Saharan Africa. So, we find the broad theme of economic development in Africa to be interesting and good, but not quite the bar that we look for when it comes to those sort of direct impacts on communities.
May I jump in with a question? No.
Sure.
Are there any areas like maybe your programmatic areas where you would not pursue an investment if it only meets a relatively low impact bar? And there. Or a different way to think about it. I think one way that I think we think about it is where the risk of getting it wrong, or think about sort of impact downside risk, is sort of too high. And so for us, like financial services, for example, has been one where I think we would are unlikely to pursue an investment in a low-income financial institution in emerging markets unless it meets a very high impact bar, because the okay impact bar could very easily kind of derail it from okay to not okay.
I would say that anything that we do with in either the impact-driven strategy or the programmatic strategy, in any case, I think we are thinking hard about unintended consequences. We're thinking hard about second-order impacts and what can go wrong. I think we've written pretty extensively on our experiences in the energy access sector and some of the concerns that we began to have about the growth trajectory in the sector, and some concerns with over-indebtedness. And so I think we're pretty kind of open and honest and transparent about when we see the opportunity for for things to go wrong. If I just take one example from that portfolio that kind of exemplifies that responsible investment bucket, generation investment. I think probably most everyone on the call has probably heard of generation. Global public equity fund, thinking about sustainability and resource scarcity really as a theme to invest around. They've grown into a really large asset holder, $15 billion across a range of strategies. We break these managers down into impact, financial return, and risk. We viewed the impact as pretty low in terms of what generation can actually do. I think it's good to have active shareholders who are engaged with the enterprises, and they certainly are proactive with management teams, but measured against our bar of is this having a measurable impact on underserved communities? It's obviously very low. Financial returns are very high. Generation has performed very well against benchmarks, and again, risk of capital impairment is very low. Obviously, there's public market volatility, but we view this as pretty low. So this, to me, fits classically the responsible investment category where, you know, relatively low risk, you know, market correlated returns, and yeah, fine impact, better than no, better than nothing. If we move to the impact-driven capital preservation portion of our portfolio, you'll see a wide range of names. You'll see both funds and some direct lending work. And I'll highlight Advanced Global Capital, but you'll see some names like Root Capital and Global Partnership and Microvest that are you know, that are sort of classic names in the impact investment world. You'll see some newer you know, newer lenders like Lendable and Community Investment Management that are, you know, aggregating assets to focus on specific opportunities that we think are interesting. Whoops, sorry, I just lost our deck for a sec. If I flip through to AGC, I think this will give you a good sense of the kind of manager that we like for our capital preservation strategy. AGC is a newer manager, launched in the last few years, focused on factoring in emerging economies. Factoring, for those of you who are unfamiliar, is essentially buying invoices at a discount. It allows small businesses that are generally selling to you know, to retailers or aggregators to get that money in their pocket today versus waiting for that large buyer to pay in 60 or 90 days. This makes a huge difference in agricultural value chains that we care a lot about. So the difference between you know, a small farmer, small dairy delivering you know, say milk to a processor and getting paid, you know, at the point of delivering those goods versus getting paid 90 days. It's a big difference in their livelihood, a big difference in their ability to invest in their own small business. So you know, AGC uses the credit worthiness of the buyer in order to advance funds to you know, to small suppliers. And I'd say they do this in a way that both has impact but actually generates pretty good returns by virtue of the fact that it's very short duration credit, and most of that credit risk again falls on that large purchaser. So you know, if there are these very rare opportunities where you actually produce what we view as very high impact for, you know, for underserved market segments and produce returns that actually look pretty decent, you know, AGC is a good example of that.
Just one quick question on this category for you, the capital preservation. It's interesting that you're able to put in the same category some of these more established institutions like a Microvest alongside like a Lendable, right? A newer strategy, newer entity. And obviously it would not fit the traditional, if you had sent it to any of your investment advisors, they certainly, my guess is, would not put Lendable. I don't know Lendable well, but just to pick as an example, would probably not put them in your low risk category from using the traditional underwriting criteria. And so are you able to get comfortable with that based on sort of how you structure the investment, just kind of being closer to the investment? How do you get comfortable with those to put them in your low risk?
Yeah, I think it's the experience of doing, you know, doing a good number of these transactions and just getting more comfortable with underwriting, you know, underwriting transactions in hard markets. I think a lot of things get kicked out by traditional advisors because they, you know, haven't had the repeat experience of doing things in certain places, and that's understandable because the vast majority of you know, financial advisors, even impact-oriented financial advisors, are you know, their expertise and capabilities are oriented toward a certain client profile, a certain client risk tolerance. So they reasonably and understandably don't get a lot of experience doing deals that fall outside of that sort of, you know, prescribed circle of deals. So I think you know, on things like Lendable and other newer, either newer managers or newer enterprises, I think, I think we've developed enough in-house expertise to feel, to feel comfortable. In most of these cases, we also are a lender, so we're not, we're obviously taking equity-like risk on some of these enterprises, even as a lender. We are, we're not taking the kind of long-term corporate solvency and corporate success risks that that an equity investor in some of these enterprises would be, which is why we can fit some of these into this capital preservation mandate. The second example I had in the deck of what we think of as capital preservation is global partnerships. Global partnerships has been around for quite a while, 20 years, lending to microfinance and low-income finance institutions, primarily in Latin and South America, though has expanded recently to Africa. We view their sort of impact reporting capabilities and impact outcomes as really top-notch. We view the risk of what they're doing as pretty low in the sense of both how they've structured themselves as a fund with first loss tranches, as well as the experience that they've gained in mitigating things like country risk and currency risk and a broad and diversified portfolio. The financial returns are relatively low, certainly not the right, certainly not what a financial investor would deem risk-adjusted returns for investing in, in emerging economies. But for our capital preservation strategy, these are returns that are perfectly good, perfectly good and feel right for the kinds of impacts that global partnerships has on the sort of communities that they serve. And then finally, before we can sort of open it up for some questions, and here we'll give some examples, we'll open up for some questions, is our programmatic pool of money that, primarily PRIs, but you'll see some things in here that actually are more commercial investments, but happen to be, quite novel or pioneering or high risk. Things like, a large SPV that we structured for off-grid electric, that wasn't a PRI, but, from our perspective, a brand new type of transaction in a new market with significant risk. And then you'll see a wide range of kind of pilot lending in agriculture to organizations like Apollo or Myagro, and even some grant-based work for folks like Cola Life and Frontier Markets. The example I had in the deck as a good example of what we do on the programmatic side is One Acre Fund. We think One Acre is one of the most effective organizations at increasing farmer incomes in a very measurable way. They're working in East Africa. They primarily provide loans to small farmers in the form of seed and fertilizer and agronomic advice, and they collect on those loans when farmers are able to pay at harvest time. They've become not only a huge organization in terms of the farmers they serve, but also one of the largest employers in Kenya and Rwanda. This is an interesting example where, impacts off the charts for us in terms of target communities. There certainly is some risk in what they do in terms of geographic concentration, and in terms of the risk that all smallholders face in developing economies with swings in commodity prices or weather. But in general, they have been scaling for years. They are cross-subsidized with a lot of grant capital. So the risk of impairment of our debt we've sort of viewed as medium, and the financial return is sort of medium to low on our scale. So actually, we ended up making this as a PRI initially, a 2-year 2% note. We're actually, in the spirit of ultra transparency, talking to them now about a larger note that would come potentially from the foundation endowment, in the form of sort of an MRI, mission-related investment, be at a slightly higher interest rate. So some of these things definitely are fluid in terms of where they sit, whether they're sitting in programmatic or capital preservation. So hopefully that's a quick run through of of how our strategies get mapped onto real opportunities. Everyone's got these slides, so you can look at each individual opportunity, and I'll give it back to Aner for a couple comments on his portfolio, Candid's portfolio, and then we'll get some questions in.
So let me jump in quickly, Greg, before we turn it over to Aner, so that Aner can then address the same question. I think that part of the interest from some of the folks on the webinar from the investor network community that had heard about the work of Ceniarth and his approach is, wow, it is so far afield from what we're doing. How do we start moving in that direction? And besides saying, get a Diane type of person to allocate capital, is there something that you've seen or that you could suggest, and then Aner, in terms of the families that you work with, where you can start from where most family offices are today in the impact space to where Ceniarth is?
Yeah, so I guess my response to that is that, these kind of strategies really need to be driven by the asset owners. Whether that's an individual in the case of family offices, or that's a board in the case of foundations. My belief is that to do the kind of work we do, it really takes that level of leadership and kind of executive buy-in to say, this is where we're going. This is what do I want to achieve with this capital. This is, how I view this money, and let's sort of get this done. And my anecdotal observation is that that there actually are more asset owners out there in the world who have the propensity and kind of desire to do this kind of work, and that oftentimes it's not necessarily the asset owner's desires that are standing in the way, but investment advisors or fund managers who have basically created the sense of, oh, you can still have it all, but they've created strategies that you can have financial returns and you can have great impact. Don't worry, that impact you want to achieve, it's going to be achieved through this financial strategy as well. And that by painting that picture and by basically setting the bar low for folks who don't get deeply involved on a day-to-day level, we kind of stop that capital at a certain point. Whereas I think that if more of those asset owners were actually empowered to kind of see through that vision of having real deep impact in hard places, it might not be as lucrative for fund managers or financial advisors in the middle of these transactions, but I think it actually would ultimately fulfill the vision of what a lot of people want to achieve. I might be optimistic about that, but that's just my my observation.
I'd say it's a tough one. I think our role as advisors or intermediaries or investment professionals is to sort of basically highlight what we think is achievable if you had that a part of your portfolio that can do this, right? We bring forth opportunities, and we don't sort of try to sugarcoat them, right? It's like, okay, this one could really, be transformative to these communities, but it's going to require, X, Y, Z in terms of risk or in terms of our return trade-off. So I think it's our role to kind of, here's what what is possible if we make room, if we make space for those investments in the portfolio, and then I think you can have. Then I would somewhat echo. To be honest, I don't know. We have had these conversations with a lot of asset owners, so I don't pretend to know. But I think I'm somewhat optimistic, to echo Greg here, that there's at least, even if they're not going to go as far as what Diane's doing and say, hey, great, I want as much of my capital as possible to do this, that there are parts of the portfolio that there's, where, be it the family office, the foundation, inside a trust, outside a trust. Personally, there's, money sitting in different places and might have different levels of flexibility to it. By the way, the slide here with some of the investment examples, that excludes actually many of our riskier investments that sit in donor advised funds. So outside of these two entities. So that's kind of one very tactical way that for the asset owners that we work with have leveraged that capital, right? Yeah. So we've set up 2 donor advised funds with impact assets, and those have been more flexible types of capital.
Yeah, and I think I was. I'll just one thing. I think I was. I can be a bit snarky and flippant about kind of responsible investing as the bar for success. And I guess the only thing I just want to make clear is that that I do think these choices are very personal for families, and I think that there are real financial needs and liquidity needs of people for whom moving capital in the direction of responsible investing is a big leap, and I think we should acknowledge that's great. I think in general, the types of organizations, the types of family offices that are able to sort of pursue these really higher impact strategies are offices that are really saying, look, we have an asset base that no individual needs, that there is no marginal personal utility out of these dollars. As Warren Buffett once said, I've never given away a dollar that had any marginal utility to me. And I think that when I think about the kinds of offices that should really be kind of pioneers in this field, it's those offices that are large enough, those families that are large enough to really begin to detach themselves from the idea of why do I need why do I need to have 5% more, 10% more? Is there really an opportunity to relax that constraint to sort of keep up with that rate of return and just say, look, at this point, let's just try to have impact with this capital that we're never gonna really need. So I think that's that's sort of the best way I could say how sort of Diane thinks about advocating for this kind of strategy.
Right, but that I think, Greg, brings up 2 interesting points from that field building perspective, so to speak. One is to be mindful around where in the rare occasions where you have a principal that is interested in this sort of strategies, to ensure that they don't get sideswiped or sort of detoured by managers that say, oh, well, there is this or there is that, as opposed to really meeting the impact aspirations of the principal, right?
Yeah.
It's few and far between that capital that we should really ensure that, to the extent that somebody wants to go down that route and says, look, I have really no marginal use for that dollar, as rather than the marginal use that will come from the impact, that they are given those opportunities. And secondly, at the cost perhaps of being a little more controversial, which it's not like we've shied away from that in the past, this leads to a position around you can have your cake and eat it too, which is not just neutral, right? It's not just a matter of saying, oh, there's that strategy over there that actually still seeks to maximize returns, and there's our strategy over here that at least looks first at impact, but there is a cost that is imposed on the system in terms of the plausibility of pursuing these alternative strategies when you have managers that are promising that kind of returns, right? If somebody say, hey, you can have all the impact in the world and beat the market, makes it a little bit harder for the ones that say, no, actually, I mean, the expectations at the field level are being skewed, and that's what I'm trying to address here.
Yeah, and the only thing I'll say to clarify is, you know, I obviously feel very strongly that there are trade-offs when one is working on issues of poverty and social outcomes in very hard places. You know, I do think that there are other, depending on how you define impact, I actually think there are categories where you can have very high impact and make really good returns, right? I think if you're an environmental or a climate funder, I think there are good opportunities to make really good returns and have really strong environmental benefits. If you're a funder who's really focused on the education system or the healthcare system in developed economies, I think you could probably make money in, you know, ed tech or, you know, healthcare innovation in developed markets that are going to have, you know, good impacts on, you know, on things you care about, and will have good returns. So, you know, I think that this, you know, again, for me, it's really not a debate. It's really more an issue of helping family offices and foundations define the specific kinds of impacts that they want to have in the world, and then you know, matching vehicles and matching ideas to those kinds of impacts. And you know, if your impact criteria is different, then by all means, maybe you will be able to create a portfolio that has really high returns and has high impacts on your area. I just know that from the work we do and our mandate to have impacts on, you know, deeply underserved communities, that's not something that it's not something you can really do at scale.
Right. An important qualifier there was, well, if it is the type of impact that you're looking for. And what I'm getting at here is perhaps, if I remember correctly from some of your earlier writings, right, the analogy with the diet. If somebody says to you, oh, all you have to do is eat with your left hand and you will lose weight, right? That makes it harder to then go for the prescription of a doctor that says, no, actually, you've got to work out and do some of the hard work around it, right? It's more around that false promise that I'm getting at. Anyway.
Okay. Good.
Aner?
Well, I mean, I think let's make sure that nobody wants to jump in with questions, maybe, because I know we're
there's one there is one question on chat that I'll just knock out quite quickly. I think it looks like Chet asked whether our PRIs count as part of our distribution requirement. We are, and whether we're registered U.S. private foundation or do we do PRIs above our 5%. An easy answer, which is PRIs count toward our distribution requirement. It hasn't, you know, he also asked, did it decrease grant making in lieu of PRIs? And it didn't, in the sense that as almost a brand new foundation, we didn't have very established grant programs that were displaced by our movement toward PRIs. You know, we've done a little bit of grant making in the past, but in general, this has sort of been the formative strategy of the foundation, and will be going forward. So that's how we think about it. And I'd say we kind of flex around our distribution requirement. You know, it's you know, again, we're a young organization, so I can't say anything is, you know, I can't say we have a 10-year track record of saying, hey, we usually do more than 5 or less than 8, but I think you know, we'll flex above 5 when we have good opportunities.
Yeah, maybe let's see if there were any other pressing questions, and then we'll turn it over to Aner.
Or non-pressing questions. Right?
Yeah. Feel free to unmute yourselves, do what you need to do. Go ahead, Aner.
Just back to the slide. Yeah, so I mean, these are a few examples of our sort of 3 categories: the OK impact and commercial, targeting commercial returns, and then the two other subcategories are higher risk or lower return. And you'll sort of notice in general the the OK impact, commercial return category tends to include fund managers on a sort of a third fund or so. They have a bit more track record. So here's DBL Partners, HCAP, collaborative fund, some direct, more sort of growth stage investments like Mosaic or Complete Solar. And then on the kind of the high risk, and I'm sorry, I'm talking through the kind of the private equity part of the portfolio here now. The higher risk investments would include, as I mentioned, sort of emerging strategies, emerging new fund managers. These are often first-time funds, often really subscale funds, if we believe they're doing something unique, differentiated, impactful, and we might decide we'd want to be a part of that ladder, the first few steps of their ladder in proving out their strategy. So these are not, these would be examples of strategies that are pursuing market rate returns in general. I mean, they would argue their strategies are every bit as competitive with non-impact managers. It's just that they're new and they're subscale, and there's a need for more risk tolerance going in. And then what low return strategies. So it's interesting because obviously the obvious investments under kind of low return are debt opportunities, right? Are low interest loans where there's a lot of downside protection and a healthy sort of first loss equity buffer, and those are the opportunities that Greg mentioned, and some here of our notes are mentioned here, like a few CDFIs we worked with, like CI Maine or New Hampshire Community Loan Fund, and a couple of lenders you saw on Greg's list as well, like Global Partnerships and Root Capital. I think that's less obvious here is on the private equity side, right? Finding sort of what is a lower return, lower risk strategy in private equity, especially I think in our field in general, and the fund managers in our field tend to be more venture, more skewed to sort of early stage venture. But it is a category that we want to see more of, in part because of, I think, similar to what how Greg described Diane. I think there tends to be this general sort of constitution that from the family saying, well, if this is if this is a really great, impactful company or manager, and a low risk of capital impairment, that tends to be sort of more the emphasis than necessarily are we getting a 10x on this one, right? So so there's a couple of instances here where sort of unconventional direct equity investments, like traditional medicinals, which was the tea company that was, and the lead investor was actually a venture fund, the Builders Fund, but this is obviously a business that's really very well established, but also there's some I guess unorthodox structuring involved because the founders are so incredibly committed to retaining ownership, long-term ownership for the business, and there's certainly the possibility here that investors will be giving up some upside, potential upside, if if they were open to selling the business to Coca-Cola, they might fetch a much higher multiple, but it's one where it's a sort of solid, growing, very healthy, growing business, not likely to lose money, but also not likely to generate a 10x. So we're happy to do more of those. I'll pause there maybe. So, I mean, I think I know we're past our time. We were going to spend a few minutes talking through how we determine whether whether something is high impact enough to fit into to merit the higher risk or lower return. But knowing we're a little bit over time here. I'm not sure, Andrea, you guide us.
Yeah, feel free to take a few more minutes. The ones that need to jump off, by all means, do so, and we'll be able to share the recording if you want to catch the last few minutes. But Aner and Greg, if you have a few more minutes just to wrap it up, I'm happy to stay on.
Yeah, I'll make it really quick. I mean, I think in general, I mean, that's always the question we ask ourselves and we get asked, right? Is if you're willing to take that trade-off, how do you know when to take it, right? How do you know that something is impactful enough? And often the way we do it is, I think if we see and we're generalists, we work across developed and developing markets, across environmental strategies and more social strategies and sectors, and but where we see a handful, a universe of potential opportunities, be it timber managers or affordable housing managers or renewable energy developers, will sort of try to take a step back and sort of develop what our framework would be of what does constitute, what does the kind of gold standard best-in-class impact for that sector look like, and we kind of call that scale, or a good, better, best scale, right? What is the sort of good impact, base level impact, if you will, in that sector, and what does a best-in-class actor look like? Doesn't necessarily mean we always end up backing the best-in-class impact strategy, because it might not fit in the portfolio, or it might not be investable, but we try to do that work. And that work means, again, looking across managers, across strategies, and then also taking the time to, work with peers, co-investors that are more specialized in that sector, that can help inform our understanding of that sector, as well as non-investors, right? Advocacy groups, and more of the link that transform finance, quite frankly, can provide to the sort of community activists that can help inform those guidelines, or what to watch out for in each of those sectors. So this is just a kind of we tend to land on these 4 high-level questions that sort of differ by sector, but the high-level questions we look for in each sector are, fall into these 4 categories: communities, best practices, value add, and transition plans. So communities, as sort of implied, how are communities engage in the process? How do they bear the risk? How much of the benefit do they capture? Are they intrinsically involved in ownership or governance, et cetera? Best practices has to do with operating standards or certification standards, and is the manager or the company working in line with those best-in-class standards, as defined, hopefully, not just by the investment community. Value add has to do with sort of, you think about kind of the delta, or sort of how different is the manager versus what the baseline for that sector, for that location is, right? For a non-impact manager, or even another impact manager, right? So how much of a difference does this particular strategy make versus a baseline? And then lastly, the point around transition plan. What is the manager or the company thoughtful and intentional around long-term mission preservation? And that tends to apply roughly fairly well across sectors and across asset classes. So I think that's it for me.
Great, thank you. And as a last point on the transition plan, I would say, yeah, it matches well the work that we've been doing recently on alternative structures, right? Done in a way that makes the ownership and the governance of the assets rest with the community or with the founders, whoever it is, in terms of self-liquidating equity, in terms of some of the work that DIF that I saw in your portfolio there is doing when they evaluate their own impact against the kind of the impact of the exit itself towards sustainable impact and the like. So there's a lot there that we could unpack, and clearly it is a much longer conversation than an hour and a half. But I'm glad that at least we could get started with this. Greg, was there anything that you would like to add as we wrap up?
No, I think that's good. Thanks everyone for joining, and email address is up there on the screen if anyone flips through slides and has questions afterwards. Great. Well, thank you both for joining us, and I'm hoping that this will, if nothing else, spur some more conversation among the participants. Please do reach out to us with any feedback or any thoughts that Aner and Greg stimulated in your own approach. And I think it's worthwhile really in this kind of non-judgment space to see what are several different approaches that might work based on differences in the perspective, in the size, in the kind of fiduciary requirements of the principal and the like. So we definitely look forward to exploring that more. And in fact, down the road, we'll have another presentation with Mara Bollis from Oxfam that had authored that report with Sumerian Partners back in the spring on sort of broad concessionary needs in impact investing, and recently came up with another piece in SSIR. So it is an ongoing conversation, and I'm glad that Aner and Greg were here to jumpstart it with us. And if you're interested in the work of the Transform Finance Investor Network more generally, please feel free to reach out to me or to Kurt. His address is here. And as we said at the beginning, we are looking to hire for the investor engagement manager position. So if you know anybody, send them our way. And keep an eye out for the release of Morgan's book that, again, covers a lot of the topics that we covered today. Aner, Greg, thank you so much for joining us. Thanks for everybody. Sorry we went a few minutes over, but there was just so much to cover here.
Thanks.
Thank you.
Thank you.
All right. Take care, everyone. Bye-bye.